innovate, enable. Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to this special conversation. Kotak Mutual Fund presents Investmentor in association with Network 18, an investor education initiative. I'm Surabhi Upadhyay. Now, over the last couple of weeks, you have been hearing experts give advice and clarity on a lot of important subjects relating with investing, types of mutual funds, looking at your risk profile, basic steps getting started, so on and so forth. Today, we're going to discuss another very, very important topic, and that is the importance of not over-diversifying. Yes, over the past few weeks, you've heard experts tell you why you need to diversify, but it's equally important to know when to draw the line and why not to over-diversify. To take this conversation forward, I have with me Mr. C. Jayaram of Kotak Mahindra Bank, as well as Harsha Upadhyaya of Kotak Mahindra Mutual Fund. Thank you, gentlemen, for joining in. I'll start by making an honest submission. Mr. Jayaram, opening thoughts from you first. For a lot of first-time investors, this can get confusing because just earlier we were discussing why one must diversify asset classes, in fact, even geographies. And today we have to discuss where to draw the line. So your first thoughts.
So I think you sort of explained that you've already discussed the importance of asset allocation and the need for basic diversification into different asset classes like equities, fixed income, real estate, etc. And I think that's the starting point, and it's absolutely essential for one to do that. But once one has got the basic asset classes established in your portfolio, then I think there is the tendency for many people to sort of over-diversify, which essentially means that assuming that you've got, let's say, 3 or 4 broad asset classes, equities, fixed income, real estate, gold, etc. And let's pick equities for a minute. I think given the fact that in the Indian context, there are at least about 30, 40 active mutual fund houses and a plethora of offerings, there is the sort of tendency for many investors to believe that if I put money into a number of these things, I'm sort of hedging my risks, and 1 or 2 of the fund managers will perform a little better than others. I think that's a very complicated route to go down by. And my advice would be that once you've established your basic asset allocation in a particular asset class, let's take equities for a minute, you just need to do some diversification there between your large caps and your mid caps. And for example, if you have picked one large cap fund, at best, you need to add another one. I would argue that more than 2 large cap funds, more than 2 mid cap funds, etc., is complicating the issue. And to that extent, more difficult for the investor to monitor as well. So I'd strongly argue that once you've picked your asset classes, then sort of stick to 1 or 2 funds in each category.
Harsha, I'm taking one step back and starting with the basic premise, which is creating your portfolio 101. Tell us about the rules to apply when you are actually adding things to your basket in terms of asset classes itself. Will it be a function of age? Will it be a function of your risk profile? I mean, how does one create that basket to begin with?
It's just not about one's age in terms of identifying various proportion for asset classes. I would say that along with age, you need to also look at risk tolerance levels. What is the investment horizon? What are the investment goals? What are the liquidity needs? These are the issues which will let you know what is the ideal or optimum asset allocation. The reason for having asset allocation or diversification between assets is to maintain a risk profile which is suitable for an investor. If you have one particular asset class and if you have all 100% of your investments in that particular asset class, your fortunes will be directly dependent on how that asset class does, and there will be no diversification benefit at all. So that's the reason one needs to look at various different asset classes which may be less correlated or uncorrelated with each other. so that at different points of time, your portfolio is stable and will not move in one single direction. It's just about the simple fact of not having all eggs in one basket.
Mr. Jayaram, your thoughts on this as well. Just the other day, I had some friends ask me about this general left out feeling, because when you hear certain asset classes do exceptionally well, the human mind tends to start sort of deviating in that direction. So how to deal with some of these issues and how to decide what all you need to be in? Because I think people, now, because there's so much information, they want to look beyond traditional avenues of just equity or fixed income.
My broad philosophy on this would be that you need to distinguish between types of investors. And at a very broad level, let's talk about the average retail investor versus a high net worth investor. To me, for the average retail investor, you need to avoid as many of these exotic products as possible and stick to 3-4 asset classes, which I would broadly classify as equities, fixed income, real estate, gold. These, to my mind, are in the Indian context, the sort of most known asset classes about which you have a lot of information, about which most people are fairly well aware of, etc. And I would sort of say that if you're a retail investor, you should not go beyond these asset classes. But the moment you become a high net worth investor, or you are classified as a high net worth investor, which essentially means that you have a higher sort of ability to take some of these calls, then it's useful to look at some of the alternate investment funds which are currently being offered, whether they are private equity funds, whether they're venture capital funds, hedge funds, and some of the more exotic ones which you talked about, etc. But I think those should come into play only if somebody is a high net worth investor, which essentially means that he has the capability to take higher losses if it so happens.
Now, Harsha, I want to come to the opening remarks that Mr. Jayaram was making when he was saying, how do you decide where to draw the line? And he was referring to equities as an asset class. Now, here for a lot of people, the route to the equity market is mutual funds. Is there a rule of thumb here? How many funds is the right number, and how do you decide? Because I think 16 fixed income categories and I think more than 10 equity categories. So how do you decide?
You are right, Surabhi. To an extent, this becomes very, very difficult for a normal retail investor. And that's why we would advise that they take financial advice from an expert. As far as number of funds are concerned, I think it would depend on what kind of risk profile a person has, what are the liquidity needs, what is the investment horizon, etc. For example, if you are investing in equity funds, obviously your investment horizon has to be higher than what you would ideally do for a fixed income fund or a money market fund. And also in terms of the risk tolerance, equity funds would need a higher risk tolerance as compared to fixed income or money market funds. Overall, I would say that you should not have too many funds of the similar nature. For example, if you are investing in equities, if you have 5 large cap funds in your portfolio, that's not a good diversification, I would say. Because when you have similar funds which follow a similar strategy, then most of these funds would behave in a similar fashion. So the benefit of real diversification is not going to be there. So ideally, you should go into different asset classes as well as different categories of funds, so that at least some of them are less correlated with each other, so that when there is a negative drawdown in the market, for example, all of those asset classes should not behave in the same fashion, or maybe some should be inversely correlated to some of the asset classes that you have in the portfolio, so that when something falls, there is something which moves up as well. So overall, the risk is going to get diversified in that fashion. So I would say in any category, you should not have more than 1 or 2 funds of the same nature. And that's the thumb rule that one can use.
Okay, fair enough. So to elaborate on that point, Harsha, help us sort of build that up for, let's say, the equity part of a medium risk appetite investors portfolio. You have obviously the large cap, mid cap, small cap category, the flexi cap category, and then people might want to play thematic funds as well, those who have the risk appetite. So how should one sort of build this up? one per category, or is that also over diversifying too much?
There is no one size fits all kind of a solution, but I would say that not more than one or two funds in each category, and depending on what is your investment goal. For example, the most conservative equity investors can remain with large cap exposure because that's a sort of a blue chip in nature and will not have too much of volatility as compared to rest of the equity markets. And those who really are unable to take decision between how to go about allocation in categories like large cap, mid cap, and small cap can stay with flexi cap funds, because there the portfolio is managed by the fund house and the portfolio manager will decide the allocation between large cap, mid cap, and small cap categories based on relative growth and valuation metrics. If you're an aggressive investor within equities, you could look at mid caps and small caps. Obviously, these tend to be more volatile than large caps. So to that extent, the investment horizon has to be longer so that you're able to ride the entire cycle and really create wealth. And also you need to be a lot more disciplined about greed and fear in these segments, because these tend to be very volatile and the moves can be very sharp. Similarly, the thematic funds also have a place in one's portfolio, depending on whether one wants to take that kind of a risk in the portfolio. Here, the entry and exit has to be really sharp and well monitored, because no thematic fund will consistently outperform the market. There will be phases in which a particular theme will do well in the market, and you should be agile enough to get into that particular theme and get out of it at a later point of time. So these are some of the aspects that one needs to keep in mind when one is investing in equity class. I would once again say that there is no one uniform thumb rule that one can follow. It all depends on one's risk tolerance, investment horizon, liquidity needs, and investment goals, of course.
So we'll keep some of those points in mind. Quick break on that note. On the other side, we extend that conversation to other asset classes. How do you ensure that you have the right balance when it comes to diversification and that you don't spread yourselves too thin? The conversation will continue after a break.
Kotak Mutual Fund presents Investmentor in association with Network 18. Kotak Mutual Fund presents Investmentor in association with Network 18.
Welcome back. You are with us on Kotak Mutual Fund presents Investmentor in association with the Network 18. This is, of course, an investor education initiative. I'm Surabhi Upadhyay. Mr. Jayaram, I want to come to fixed income because the last 2 years have been particularly painful for a lot of investors here. It's a more complex market, as we've now understood. And here it's often said that, you shouldn't have all your eggs in one basket, or most of your eggs in one basket, because if the economy goes bad and if companies start defaulting, then as we've seen, the entire capital can also get sort of written down. So what would the first rule be here?
I think the first thing one needs to understand is that in the context of fixed income and fixed income funds, there are two different types of risk we are talking about. One is credit risk, and the other one is your risk of return in terms of higher, lower, negative, whatever. And I think to me, what seems to be happening is that while there is a lot of, there was a lot of discussion around the returns and the risks on those, not enough importance was probably given historically to credit risks involved with fixed income portfolios. And I think particularly with retail investors, there was a belief that if I sort of put in 100 rupees into a fixed income fund, it's only a question of what sort of return will I get. The concept that you could actually lose capital on a fixed income fund, I suspect even now to many retail investors is not entirely clear. So I think that's the first important sort of thing. And if you are an average retail investor, I think you should be very concerned about credit risk, and to that extent, the funds that you choose should be those where you're pretty much assured of credit quality, either through the rating process or through your financial advisor who you trust. But clearly, it must be a portfolio in which you have very high faith in the credit worthiness of that portfolio. So that's part one. And once you're over that hump, Then, of course, you come to returns. Again, you have different types of investors. Some investors who like to see a sort of predetermined type of return, for whom your ideal sort of product is something like an FMP, a fixed sort of portfolio, and that's your ideal sort of product for them. But for others who might be willing to take a call on interest rates, particularly over a longer period of term, etc., then you're talking about other products like bond funds, gilt funds, etc. So the essential thing is that you need to figure out what type of investor the person is, and depending on, again, as Harsha mentioned earlier, his risk tolerance, his understanding of some of these issues surrounding credit, returns, etc., I think you need to choose your fixed income portfolio accordingly.
Okay, got that. Harsha, come in on this. Now, since the economy is still going through a very challenging phase and we're in the second COVID wave, because the environment is risky, should one actually have, more fixed income funds just to make sure that hopefully, if there's an accident in one fund, the rest of your portfolio will benefit from the others that you have. How do you sort of look at the concept of diversification in the current environment when it comes to debt funds?
Surabhi, you need to have diversification at all points of time, not just when things are not going your way. So to that extent, I would say that you need to have fixed income, equities, real estate, gold, and various other asset classes at all points of time. As far as equities are concerned, we all know that they do well over a period of time, but there will be violent moves within that entire cycle. Today, we are in a phase where economy seems to be recovering from the COVID adverse impact. And once again, we have seen a second wave coming through. So to that extent, there could be some hiccups in terms of the economic revival. But history has also shown in the past that these kind of phases would offer better investment entry points for long-term investors. Because when everything is clear and the future is bright, you may not get it at the right valuation that you want to invest into. So to that extent, I would say that whenever there is a bit of haziness in terms of the outlook, and if the valuations are not too rich, that's a good point to really increase your equity allocation. So I would say that one could use these volatile periods in equity markets to increase their equity allocation, again, to the intended level rather than to the highest level, because everyone's risk profile will be different, and one may not have similar outlook in terms of investment goals and other issues. So one would need to sit with the financial expert and decide on the right asset allocation in terms of various asset classes at regular intervals. But I would say that we remain constructive on equity as an asset class at this point.
Now, Mr. Jayaram, you briefly touched upon sort of gold and real estate earlier, since we are talking about the right mix in terms of asset classes and how much to diversify. Would it be fair to say that, for most medium risk investors, these two asset classes should find a place in your portfolio? And then what about the go-to routes? Because now there is a non-physical way of investing in both the asset classes. So, what would you advise here?
Yeah, as a starting point, I think for both gold and real estate, I think they should form part of the portfolios of most medium risk investors. And again, depending on how large the portfolio is and what the risk tolerance is, you could figure out what those percentages could be. And I think clearly, in my mind, between gold and real estate, it shouldn't exceed 20-25% of your total portfolio. Would be the sort of allocation that I would look at. But within that, as you talked about, now there are multiple options in terms of how do you access these asset classes. And I think for real estate, now there is a particularly attractive sort of route via the real estate investment trust. Some of them have already sort of come into play. I suspect many more will come into play over the next year or two. And I think that's a really attractive sort of way for investors to look at an exposure to real estate as against your conventional historical way of actually buying a property, locking into it, because then you have actual problems subsequently in terms if you want to sort of liquidate that investment, it can sort of get troublesome. So I think real estate now you have a really good, attractive way of accessing that asset class. In the context of gold, again, it's a personal sort of preference. Personally, I would prefer gold ETFs because they're so much easier to get in and get out of. But there is a case to be made for the other one as well, where you're getting some sort of an interest return of 2.5%. So I think gold, your sort of options are both sort of attractive.
Harsha, let's wrap it up with some final thoughts then and come back to the starting point, the theme at hand. Why one must be wary of over-diversification. So what are the final rules, thoughts that you'd like to leave us with? Why should one be careful not to over-diversify?
Surabhi, there is a thin line between diversification and over-diversification. Diversification is required to optimize the overall risk that one is taking in terms of investments. And also the returns are likely to be optimal if you take diversified risk. But if you over-diversify, which means if you have too many number of funds and too many asset classes in your portfolio, ultimately, there may not be too many uncorrelated or less correlated asset classes in your portfolio, or maybe one single category of assets would be more, and hence the correlation between those would be higher, and they will all move in one direction at various points of time. So if you keep adding to same asset classes or same kind of funds, that's over-diversification. That may not really achieve the purpose of reducing the overall risk of the portfolio. And I would say that that's also likely to lead to suboptimal returns, because you end up having too many funds which will have a similar strategy and will not really help in overall returns as well. So I think while diversification is required, it is very difficult to give a thumb rule in terms of what is the right diversification. That would change from person to person depending on various factors about their investment style, their outlook, their needs, goals, etc. So I think ideally the investor should sit with a financial expert and decide on the right asset allocation and right amount of diversification.
All right, that nicely sums it up, and hopefully this has been a useful conversation for all the viewers out there. Thank you very much, Mr. Jayaram, as well as Harsha, for joining us on the show today.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus, ideate, innovate, enable.